This is going to be a very special price action video. It's going to be a complete price action course from start to finish, and I will share everything that I have learned after trading price action for over 16 years. This is a rough overview of what you can expect and what we're going to do. We start with a foundation, and then step by step we're going to build on top of that until we arrive at the end, where we're going to cover exact trading strategies and how to create trading plans. There are also going to be timestamps below the video so that you can navigate through the different chapters. First of all, what is price action? And there are many different ways of how we can talk about price action and the different concepts. Many of you will probably heard about specific candlestick patterns. This typically ranges from looking at patterns that include 1 to 3, maybe 4 candlestick patterns. Then we're going to expand our horizon and we're looking at broader chart patterns. Here we are talking about maybe 10, 20, a few dozen candlesticks that build specific chart patterns to help us find trade entries. But also chart concepts fall under price action, and here we are going to talk about supply and demand, support and resistance, trend lines and other important concepts. But even indicators classify as price action, and some of the most successful traders of all times that have accumulated millions and even hundreds of millions of US dollar are using and have used price action indicators, and we're also going to cover them and I will show you how to use them. Let's start at the foundation and let's talk about candlestick anatomy, because that's really the building block of our price action charts. So when we talk about a candlestick pattern, we have a few very important key data points. We have the high of the candle, we have the low of a candlestick, and then we have the body in the middle, which represent the open of a close of a candlestick. And by analyzing the different key data points, high, low, open and close, we can make assumptions about the strength of a candlestick. When we have candles with a large body and smaller wicks, we are talking about strong candles like here and this one and here at the top right. We have neutral candlesticks where we have a long candlestick wick to the upside and to the downside and a relatively small body. Those are then also sometimes referred to as doji patterns or as well pin bars. And those different candlesticks with the different bodies and the sizes and the wicks, they tell us different stories about the underlying price action, and they help us understand what the market has done and what is going to happen next, or at least what is likely to happen next. The next important thing when it comes to understanding and reading candlesticks is how the market responds to candlestick highs and lows. We are here in an uptrend, and what we can generally see in an uptrend that the market is not responding to lows, it's not taking out lows. So when we look at the lows of the candlestick, from here to here, here to here, here to here, and from this one to this one, the market is not able to reach the lows. And if the market is reaching lows, such as here, there's just a rejection. The market is never closing below a low. And that is generally what we consider a healthy uptrend. The market is not pushing into previous lows, and the market keeps taking out highs. That's a healthy uptrend. When this changes, so we are here in the uptrend, the market is not reaching the lows and keeps taking out highs, that's a healthy uptrend. But then here at the top this changes, the market is not reaching daily highs anymore as easily, and then here it's taking out lows. That's really important. When a market is taking out a low, that often signals a trend change. So you can see when we look just at those key data points, highs and lows, opens and closes, and how candlesticks and previous candlesticks relate and react to those key data points, we can gain quite a few insights and very important insights about the strength of the move, and is the market more in a bullish or in a bearish environment currently. We will get back to the video in a moment, but I want to show you my new trading program where I've packed my 16 years of trading experience in just a few hours. In the trading program, you'll get a brand new trading course with over 80 videos, and I have included ready-to-use trading strategies with rules for entries and exits. You'll learn about risk management, psychology, and so much more. There's also mentoring included, and you can reach out to me 7 days a week in our private community. I'm always there to help, and if you have any questions about your trading, you want to get my advice on a chart, you can reach out to me and you will always be able to interact with me directly. There are regular live webinars taking place, and you will become part of a lively community with traders from all around the world. We have had great feedback from our community and from our users, and the Tradecademy is the program I wish I had when I started trading 16 years ago. I am your mentor. I'm not using other teachers, I'm not using other mentors. You're always interacting with me directly, and you can reach out to me 7 days a week. The program works for day trading, swing trading, and basically all the time frames. Make sure to check the link in the video description to find out more about the Tradecademy. There's also a discount code waiting, so if you want to join now, use the discount code provided in the link and you will be able to save on your subscription. I look forward to welcoming you in our Tradecademy. And now back to the video. Let's take this a little step further, and now we're going to look at specific candlestick patterns and how we can use candlestick analysis. First of all, I want to explain the deceleration pattern. It's one of my most favorite patterns, and this is a really important one. So what we see here is that the market is in a very, very strong uptrend, right? The market is not taking out lows and the market keeps taking out highs and keeps pushing higher. Here we have a strong to neutral, so bullish to neutral candlestick progression. Whereas the previous candlestick was bullish, now we have a neutral one. The candle is red, the market was not able to close above the highs. But is this enough to go short? No, of course not. And you can see that this is quite common in an uptrend. We have a strong move to the upside and neutral candlesticks, but the market never reversed and the market never challenged lows. So the market was never able to take out lows. Here the same, strong uptrend, strong bullish push, and then here neutral candles, but again the lows were never challenged. So the trend structure was never challenged. This changes here. Now after the neutral candle, the market reverses and takes out the lows and takes it out in a very, very strong fashion. That's a very different picture than what we have seen here previously. This never occurred in this previous uptrend here. So now we can see we have this progression from strong buying to neutral candlestick to strong selling. And this is what we call a deceleration and acceleration pattern. In some books, this is referred to as the morning or the evening star pattern. It's a really, really important 3 candlestick pattern. And you can see afterwards the market behaved very differently. The market rejected the highs. It moved into the high of this candle, but was not closing here and moved significantly lower. And then you can see the market keeps taking out lows and then moves lower. So this is a very important pattern. And then you can see the downtrend unfolded. The market never challenged highs here really. There was never a time where the market closed above a high and the market kept pushing into lows. This changes here. We have price reversing. Now the market is not able to reach a low and the market takes out the high fully here of the previous candle with a strong momentum candle. This is then the signal that the downtrend is not necessarily likely to be over, but at least it's good time if you have caught the initial move here to the downside to think about exits or scaling out of your position. Next, let's talk about a momentum candlestick and the engulfing pattern. So what we see here is the market is in an uptrend. We have here signs of a deceleration acceleration pattern, right? You can see strong bullish momentum enters into a neutral candle. And then here we have strong bearish candle. The bearish candle is not as strong as in the previous example. Why is that so? Can you see it? It's because the market didn't close below the low of the candle. It's very important to see how the market is reacting to lows. Is the market able to take out previous lows, which means closing below a previous low? That's a much stronger signal than moving into a low and then rejecting it. And then here the next candle, that's the engulfing one. Why is it engulfing? Because the full range of the candle from the top to the bottom is completely outside or engulfs the previous candle. That's reversing momentum. That's continuation momentum in the uptrend. So it's not only about specific candlesticks, and it's not only enough to look for an engulfing candlestick and then jump long onto it, but you also have to analyze the trend and where does it occur. Here the market is in a strong uptrend and an engulfing candlestick after the failed reversal here is a much stronger signal in this broader context. You can see what is the market doing. Take out the high, close above the high. Yes, there's a wick. A lot of traders get easily scared by wicks, which I think is not really a thing that you should have in your trading. Wicks are not as threatening as many traders think it is. And what you see is that the market closed above the high. That's a really important signal. And you can see there was the wick. The market closed above the previous high. Here another attempt. The market didn't close above the high, but it also never took out the lows. So the uptrend is not challenged. Just because you have a wick to the upside, it doesn't mean that the market is going to suddenly reverse on the spot. There need to be more context. Here the context is not changed to a bearish sentiment. The next candle takes out the lows but rejects the lows, and you can see we take out the highs, move higher further. Very interesting progression. The market never challenged lows. The market is never able to take out a low fully. Keeps moving higher. We see a little bit of a fading momentum structure where the price is not really able to close above highs as strongly anymore. This is what we call an inside candle, because this candle is fully inside of the range of the previous candle. So this shows us a neutral market where the market is just pausing and not doing anything. So the next candle is really important after a neutral candle. Just like here, we have a neutral candle and the market didn't follow through. In the previous example, we had the neutral candle and the market did take out the low. Here we have a neutral candle and the market does take out the low, doesn't come close to the high, and we have a very strong resistance area here, overhead supply, that the market is not able to break through. And that is then often a sign that at least the uptrend is pausing, and there's a good chance that the market might now either move sideways or completely reverse if we see more follow-through momentum on the downside. Now we're moving a little bit more into more advanced concepts of candlestick and price action. So we're here on a higher time frame, that's the 4-hour time frame, and we're seeing a pin bar. What else can we see? That the market is decelerating. The candlesticks in size become smaller and smaller, right? Each body is smaller than the one before. Important is that the market is still not able to take out the lows. So the lows are moving higher and the market is never moving into a low. So the uptrend is still in play. However, the price action is getting a little bit weaker. And let's try to look into this candlestick pattern on a lower time frame. What does this candlestick look like on a microstructure? We go to the 5-minute, and this is the pin bar that we are observing. We have a strong wick to the upside, right? The wick to the upside, because we have a small body, is represented by this impulsive move up and then the immediate rejection. This is what we call a V-top, and a V-top is a strong rejection pattern. It is the attempt of the buyers to push higher, but then the buyers fail to move the market higher, and there's an immediate collapse back into the previous range that we have observed here. It's also very important to analyze the distance between highs. Whereas previously the market pushed higher very easily, in this case the market just was not able to move higher at all. The market just stayed here for now at least. The idea for trading this on a higher time frame is typically you want to wait, as I explained, for the market to take out a previous low. The low of the candlestick is going to be here in this range, right? So you'd want to wait for a strong reversing signal. The reversing signal happens when the market takes out a low. That's usually a good sign on a higher time frame that the price dynamic and the power strength are shifting. Now we go to the 1-minute. We want to look at this pattern, right, on the lower time frame. So we go from 5-minute and we observe this latest price action on the 1-minute. And what we can see is that it looks really similar, right? This pattern, higher high, lower high, and here with the trend line is almost identical on the 1-minute. We have higher high and lower high. And that is what we call the fractal nature of the market, which means that the patterns that you see on a higher time frame will repeat itself on the lower time frame. So you can see the same pattern on a daily, on the 4-hour, on the 1-hour, the 15-minute, even on the 1-minute time frame. So if you want to trade a specific pattern, the time frames are really up to you. You can choose the time frame that you feel most comfortable with. And that is a really important lesson. Again, it's called the fractal nature of the market. Now let's continue, and now we move on to chart phases. And here we're going to really understand how trends move, how our charts are building, and we're going to look behind the building blocks of trends. So when you look at a chart, you will typically see that the market does one of three things. It either goes up, it goes sideways, or it goes down. But there are also sub-trends. So you can see when the market is moving sideways, you have periods where it goes up, you have periods where it goes down, and even in an uptrend, you have periods where the market goes down and it moves against the trend, and then you have continuations. And this is typically how trends unfold. Trends don't move in straight lines. There's this back and forth between the buyers and the sellers. The buyers and the sellers, that's how the price is moving. That's why the price is moving. When there are more buyers, the market moves higher. When there's more sellers and not as many buyers, the market moves down. And we can learn to decode this buyer and the seller flow by looking at the waves. And those waves are really important, as we can see in a moment. And there are different terms that we use. In a downtrend, we call the waves that go into the trend direction, we call them impulsive waves, right? So the moves into the trend direction are called impulsive, and the moves that go against the trend direction are called corrective waves. And in a case of an uptrend, it's obviously reversed. When the market is moving higher, we call the moves to the upside impulsive and the moves against the trend corrective waves. And there are several things that we can look for to understand the waves. It's the steepness. How steep is a trend wave? How long is a trend wave? So here, for example, we have a strong, steep downtrending wave. And then here we have a shorter trend wave to the upside. And also we take into consideration the height and compare it to the previous wave. So here we have a strong downtrending wave with a lot of steepness. We have a much shorter and not as high trend wave, and that's a corrective wave. It shows us that there are way more sellers than buyers because the buyers were not able to drive the price higher. And this is really important because what we want to do as traders, we look for the connections between impulsive and corrective phases. We want to trade when the market is moving, and we want to trade when the market is moving a lot. So typically what you do is you want to trade impulsive waves. You want to trade into the trend direction because that's when the market is moving the most. And what you can often do is that you wait for those corrective phases and then you look for the tipping point. When is the market going from correction to impulsive? And those are the areas where you see the best trading opportunities usually because the market has moved against the trend direction. It has recovered a bit, which means that you will get typically a better entry price. And then it's the job of the trader to look for the tipping point when the next big move is going to occur. And we can do that by using chart patterns. I hope by now it has become clear why we use patterns. The patterns are the connectors and the patterns are transitions between impulsive and corrective phases. And they offer the perfect entry opportunity into momentum. We want to go with the trending moves. The patterns are what connect the different moves. And we're going to see that now. Let's start with the cup and handle. It's a continuation pattern. It's a breakout build-up and it has pressure components and it's a complex pattern. So what do we see here? And you can, by the way, trade those patterns on stocks, Forex, futures, indices. Those patterns have been around for decades and some patterns have been around for more than 100 years. So let's look at this pattern. This is a great pattern. You can find this on all time frames, on all markets. The market is in an uptrend. Then we have the first correction. We have the next push back into the same resistance area, push to the downside. This time it's not as deep. Then we have another push, and this time the market is not pushing lower at all. And this shows us that the pressure is building here. There's not as much selling interest here. And the buyers who bought the price up previously are coming back sooner. That's a really important signal in the market. When buyers are coming back sooner, it shows us that there's a lot of buying interest and the selling interest is fading. We also have this very great horizontal resistance that we can use for our trade timing. What we do is we wait for the market to close above this and to break above this, and that is then when we look for entries. This also shows us absorption when we look at the distance between the touch points at the resistance. Coming from an uptrend, we have our high point here. Then it takes quite a few candles for the market to come back to this area. The next time the distance is much shorter, and then here on the third time the distance is really, really short. So how strong is the market coming back into a specific level? How soon, how quick, and how deep is it retracing in the meantime are really important characteristics about chart patterns. Here we have the breakout entry. You can either go on the candle before that, or if you are more conservative, you wait for a strong move. You can also layer volume on top of that to see if the breakout occurs with a lot of volume. That's where breakout traders are getting into the trade. Then this is typically where you have your stop zone. Often we have stop runs, so you don't want to put your stop too close to the breakout area. You want to give it a little bit of room. And then the continuation often, not always, will occur here with this pattern. So it's really important to see the context. You are in a trending market, you have a great level, the market is coming back to the level sooner, the market is not selling off a lot, and then before the breakout you have really this contraction here in the pattern. Next is a wedge. The wedge is a trend reversal, it's momentum fading, and here we use a trend line. What we see is that the market is in a downtrend, and in the downtrend we can connect the highs and the lows at the swing points. And what we can see is that we have weakness in the lows. The trend line here, the angle, is not as strong here as it used to be. Here in the beginning, the trend fell really, really fast. It's a very steep decline. Whereas here, you can see there's weakness. And you can see that here even we almost have what we call a double bottom. There's almost no momentum more to the downside. And the market is kind of pausing. At the same time, now the price is pushing into the highs. It's still important to note that the market is making lower highs. You can see that we have only lower highs. Remember what we talked about in the beginning when we looked at candle highs and lows? If you would go from the 1 hour to maybe the 4 hour or to the daily chart, you would see that there are no candlestick wicks that are being taken out to the upside. So the candles are not taking out higher highs on the candlestick on a higher time frame. But this, if this occurs, it's a really important signal, as we've learned in the beginning of this video. So what you typically want to do is you wait for the market to make the move out of this wedge. This is the wedge that we are referring to. And if you get a close above this, it's a strong signal. It already shows you here in the broader picture that the market is slowing down, right? The strong steep angle is flattening here a little bit. And on the breakout, that's a very important change. As we can see here, you can see also the market now made a higher low. The market is not able to come close to the area. It's another pressure signal here, as we have seen in the cup and handle previously. The breakout entry, the stop zone typically below the recent swing lows. And then you often, not always, have this strong impulsive breakout, but those are really important patterns that will help you understand turning points. Next, let's look at a triangle. It's a continuation. Again, we have the pressure pattern, and we're using triangle horizontal levels. So again, the context is really important. We have an impulsive trend wave to the upside. Then we have here two highs, which build the resistance area. And the way the market sells off is so important. You can see we have a sell-off. Then we have the high here, the low here. We have a higher low, another higher low, another higher low, and then the release on the breakout. So you can already see when we look at the whole broader picture, we are in an uptrend, which makes more sense than to look for long opportunities. And the way the market is selling off is really, really important. If you see that the sell-offs are getting weaker and the market is being bought sooner and sooner, that's a very important shift in market sentiment. We have the stop zone here below usually the last swing point. The market is now taking out highs, and then you can see the next push. We have the same pattern here once again. The impulsive wave is here. Then the correction wave here, the market makes higher lows. It is really consolidating in this area, and then on the breakout you have a strong candle. For stock traders, you might want to look for breakouts with a lot of volume. That can be a great add-on. Also, what you typically see is a volume contraction. So just before the breakout, when the candles are really small, you will see usually that the volume is really low and really declining. That's the volume contraction. Let's talk about the fakeout and the trap pattern. It's a really important trend reversal pattern. It's more of an advanced pattern, but really important. What we see here is an uptrend, and then the market is moving sideways for a long, long time. There's a general rule that says that the longer the market is moving sideways, so the longer the price move in the corrective wave, then the higher the chance that the market will not continue. So the longer a correction wave goes on for, the lower the likelihood that the market is going to continue. This is especially true if the market has already been rallying for a long time. So if you see that you have already had maybe 3-4 impulsive waves and the market has already moved quite a lot, then the chances of a continuation are not as high anymore, especially after a long distribution. Then we have the breakout here. Look at previously. Here we don't have any pressure sign. The market is not coming into the level. There are not any more higher lows, so the market is just slowly grinding lower. So it's very different from what we've seen in a triangle, in the wedge, or in the cup and handle. The market is slowly grinding lower. Then we have an impulsive move. The volatility is also increasing. What does it mean? The candlesticks are suddenly getting larger. When candlesticks are getting larger, it often can show you that there is a tipping point in the market. There's this famous trading quote, I'm not sure who said it, maybe you can write it in the comments, that volatility is greatest at turning points. And that is what we can see here. We have the breakout attempt, and immediately after the breakout, the market falls back inside of the pattern. So an immediate rejection. We see strong selling coming into the market, and this is really the key. You have a breakout entry, but look at the last candlestick sequence. We see a lot of candlesticks here to the downside, a lot of red candlesticks, very strong candlesticks, and you can be sure there's a lot of volume behind this one as well, and very few buying candlesticks. That's the breakout entry, stop zone above this, and you can really nicely see how the market is collapsing here to the downside. Another continuation, the flag, really important and very, very popular as well. And this has been traded and observed forever in the markets. So for a flag pattern, what you do is that you look for the overall trend. The overall trend is down. We have a very strong impulsive wave, so a lot of selling over a long period of time. Then we have a corrective phase, but the correction is very weak. The market is not moving higher a lot. So we have strong selling, weak buying. What does it tell us? That there's probably a higher likelihood that the market is going to continue to the downside. We can also add a moving average. We will come back to a moving average in the future. What you see is that during a downtrend, the market is below the moving average. Here we are trading slightly above the moving average, but the moving average is still mostly flat. What you do is you wait for the market to get back below the moving average. It's like a tiebreaker that helps you to distinguish between bullish and bearish market phases. Look at this candlestick. What is it? It's an engulfing candlestick. We have also here rejection of the highs. So the market did try to move higher, but was rejected here and moved lower, closed lower, and took out all of the lows previously. And you can see that's where the next impulsive wave continued and started. So again, strong selling, weak buying, strong selling. And that is what you often see in good trending markets. Double top is a trend reversal. And again, we look for trend reversals more in mature trends. So we want to see that the market has gone up for a long time before we look for a reversal. The younger and the fresher a trend is, the lower the likelihood that we're going to see a reversal, because the market is just going and there's usually still a lot of pressure and a lot of momentum behind it. What we see is, again, strong uptrend. Then we enter a sideways phase, and the sideways phase takes a long time. The longer the distribution goes on, the longer the correction wave, the better it is for the pattern overall, and the higher the likelihood that we're going to see a successful reversal. We also don't see any signs that the market is returning to this area faster, as we've seen in the cup and handle or in the wedge or in the triangle. There are no signs that bullishness is building up here. You can also see a divergence. We can come back to this in a later part. Divergences are really important, and I have a trading strategy only with divergences for you later. We have the entry here on the breakout. The market failed to reach the highs here, right? The market made lower highs. And then we have a few candles of very strong selling here. Breakout entry, stop zone here, and then you can see we move lower. Where do we move into? This is here a demand area. We're going to cover demand areas later as well and learn what they are. Here we have a liquidity gap or a void. The market is often being sucked into those areas. And you can see there's a really strong push back into this area. And then eventually we make it even to the final target at the demand area here of the origin of this move. We will get back to the video in a moment, but I want to show you my new trading program where I've packed my 16 years of trading experience in just a few hours. In the trading program, you'll get a brand new trading course with over 80 videos, and I have included ready-to-use trading strategies with rules for entries and exits. You'll learn about risk management, psychology, and so much more. There's also mentoring included, and you can reach out to me 7 days a week in our private community. I'm always there to help, and if you have any questions about your trading, you want to get my advice on a chart, you can reach out to me and you will always be able to interact with me directly. There are regular live webinars taking place, and you will become part of a lively community with traders from all around the world. We have had great feedback from our community and from our users, and the Tradecademy is the program I wish I had when I started trading 16 years ago. I am your mentor. I'm not using other teachers. I'm not using other mentors. You're always interacting with me directly, and you can reach out to me 7 days a week. The program works for day trading, swing trading, and basically all the time frames. Make sure to check the link in the video description to find out more about the Tradecademy. There's also a discount code waiting, so if you want to join now, use the discount code provided in the link and you will be able to save on your subscription. I look forward to welcoming you in our Tradecademy. And now back to the video. One of the most iconic patterns is the head and shoulders. And we're going to take a look at it as a trend reversal, but it can also be used as a trend continuation. And this is a great pattern if you just want to get started. It's very objective, it's easy to find, and you will find it across all time frames and all markets. So this is a head and shoulders. What do we see here? And we want to look specifically at the highs and the lows. First of all, we're looking at a mature trend. The trend has been going higher for quite a while. And here, those are the points of the head and shoulder. We have the left shoulder, we have the head, which is the move from the recent high to the highest high. And then, that's the key part, from the highest high to the right shoulder, that's where the market makes a lower high. So it shows us weakness. Why does it show us weakness? It's because the market is not able to move into the previous highs. Again, remember what we said in the beginning about candlestick highs and lows. In an uptrend, you want to see that the market is taking out highs. You don't want to see that the market is failing to take out highs. So that's our first sign of weakness. Then we have the breakout entry. Again, think about the candlestick example in the beginning. Now we're taking out the lows. If we would go from this 15-minute to a 4-hour, we would see that the market is now breaking below lows and taking out lows. That's a really important trend shift. And you can see afterwards it's a complete trend change from an uptrend over the head and shoulders, which is the transition between the uptrend and the downtrend. And you can see in the downtrend we have an impulsive wave, corrective phase, and next impulsive phase. Now let's take a look at the head and shoulder as a continuation pattern. And what we see here is we have the fake out to the upside. We have here the big push. The big push is a very strong signal, but if after a big push you don't have a follow through, then that's a sign of weakness. We have the next first impulsive wave. So now we are going from an uptrend to a downtrend. And here we have the first correction. The correction is a head and shoulders, but this time it's a context of a continuation. What's the difference between the first example? Here the head and shoulders is happening after a long uptrend and it's standing here at the top of the trend, whereas here it's after a strong impulsive wave, and we're looking at this as a connector between this impulsive and a potentially next impulsive phase. We have the left shoulder to the head, which is a higher high, and then, very important, from the head to the right shoulder, the lower high. The higher and the larger the distance between the head and the right shoulder, the better it is, because it shows you really that after the head there was no more buying interest and the market was not able to come close. So the buyers are completely out of the market once again. The sellers that were presently here, they have a much higher chance to continue, and they do take over and they continue. So again, impulsive, corrective wave in the head and shoulder, impulsive wave. Let's take a look at the 1 to 3 pattern, which is one of my favorite patterns that I still trade every day. It's the trend continuation, or it can also be a reversal pattern. And a lot of also professional traders that you know from other market books, market wizards and the other ones have been using and are using the 1 to 3 pattern. It's also one of the patterns that I teach in the Tradecademy, and I show you exactly how to trade this across all time frames. What do we see here? First we look at the lows. We see that the market continuously make higher lows, right? We look at this swing point, we look at this swing point. We'll also see the highs. The market is making higher highs. And then what you want to look for is when this pattern changes. When is the market not making higher lows, but when is it making lower lows? And here, this is where the market breaks below the last low for the first time. We have a very strong push. The key is also the strength of the push. So here we have a very strong reversal push from the top of the trend to the downside. This is not enough to sell yet, but it's a very good indication that the trend is changing. In an uptrend, we have seen that we don't want to see a corrective wave that breaks a previous low. When you have a corrective wave, they're usually short-lived, they're not steep, and they're not long. But this is exactly the opposite. It's strong, it's steep, and it's long-lived, and it breaks the previous trend structure. So this is in the 1 to 3 pattern, the move from point 1, the top, to the point 2, the breakout, where the breakout is ending. And then for the point 1 to 3 pattern, we have to wait for the pattern in point 3. And that's really the key part. The point 3 has to be lower than the point 1, so it shows us that the market is not continuing with the new impulsive wave or the next impulsive wave, but the market is falling short, so we're not able to take out the highs. Then what we want to see is we have to see strong selling come back into the market. Just because the market is moving higher, we don't want to sell. We want to wait for specific clues that the sellers are coming back. This is here. We have strong selling. The stronger the selling that you see in point 3 on the retracement, the better it is. In the Tradecademy, I also explain how we can use or how we can find point 3 using other concepts such as supply and demand, fair value gaps, or even Fibonacci's. And this is typically then where you look for the entry after the strong selling momentum here. And you can see this is then very close to the next impulsive wave. So we completely change the trend. We go from uptrend to here, strong impulsive to the downside, the corrective wave, and then the strong impulsive wave. And the idea and the goal of the point 3 is to really find those transitions into the next impulsive wave. Triple tops are obviously very similar to double tops, just the only difference is that we have 3 touch points here on the high. A triple top is usually also much longer than a double top because we need to see the market give us another swing point here at the high. For the triple top, you typically don't want to see a breakout here to the upside, although if you have a breakout and an immediate reversal to the downside, that can be the component of a fake out. So you might have more than one pattern be present in your chart. And if you see that more than one pattern is present, so that you have a pattern in a pattern or 2 patterns happen at the same time, that can improve the quality of the setup. So we have a very strong uptrend that is then fading. The strong uptrend didn't have any real long sideways phases and the market always continued higher. This changed here, strong sideways phase. Now we zoom out, and this is something that we're going to cover in a moment when we look at chart concepts. We want to see where is this happening in the bigger picture. And where is this happening in the bigger picture? We look left, and it's at a previous very important turning point. The market already showed a signal here from uptrend to strong downtrend. And the great thing about this is that if the pattern now is happening at a previous point, you can be sure that a lot of traders who bought up the market, where will they have their target? They will have their target somewhere around the previous highs. A lot of traders are using previous highs and lows as their target places and for reference points. So the more traders who bought up the market are exiting here, the higher the likelihood that the market is reversing. A lot of traders are going to sit on a lot of profits because they bought the price up here for a long time, and then that contributes to selling. We zoom back in, and we can also add a moving average and a pivot. I will come back to moving average and pivots in a later part of this video, but they also help you to understand the price action. You can see in an uptrend, the pivot point, the horizontal area, they move higher, and the price is typically above the pivot point. Also, the same applies for the moving average. In an uptrend, the moving average is pointing upwards and the price is above the moving average. When this changes, that is also a change in the trend dynamics. Here we can see the price is now trading below the pivot and also below the moving average. The moving average also went from going up to now pointing sideways. It's not completely going down, but it's pointing sideways. Together with all of the confluence, the big level that we have seen when we zoom out, the triple top, the long distribution, the mature trend, and now the strong breakout. Also, you can see the market is really having problems here moving higher. So we have a significantly lower high. Those are all great confluence factors that point towards more selling to come. And that's exactly what happened. We have the strong impulsive phase, then the corrective wave back into the moving average, strong impulsive phase, and so on and so forth. So this rhythm is really observable anywhere in the charts. Then finally, we have the last pattern, the rounded top. So this shows you more of a general and of a slower transition. We have the uptrend here, and then what we see is when we look at here the highs, we see that from this high to this high, and then from here to here, the distance is slowly decreasing. So we see that the market has problems moving higher. The closer the highs are together, the more weakness it shows, and the less conviction of the buyers that are behind the push. Also, you can see that there's more selling coming into the market. So the selling waves are getting much longer and stronger. So you can see when we use here this tool, you can see that's a gradual shift. And that's why we call it a rounded top. So it's a gradual change in the market dynamics. Also, you can see that the market is not reaching with this move the previous highs at all. So it's another component of the pressure that is building. So that's really important as well. The stronger the market is sticking to a level and the further it is away from previous highs, the more important the shift here in this signal. We have the breakout entry. You can see very strong momentum here, taking out all of the previous lows. Again, just imagine how this would look on a higher time frame when you're now for the first time able to take out lows. It's a very important signal, and we have the strong push to the downside. So now we have learned about candlesticks, we have learned about chart patterns. Now let's take a look at charting concepts, and those are supporting concepts for our trades. I've briefly shown one example where we just zoomed out and looked for previous swing points, and those are the same. So let's take a look at what we have here for our supporting concepts. First, and the most popular one, is support and resistance. What is a support and resistance level? Support and resistance levels are turning points. So as a resistance level is an area where the market have moved into from below and then turned lower. And here we see it again. So this is a very strong resistance area. The market moved into it, was not able to break above it, and then moved lower from. The opposite is true for a support level. A support level is a level where the market moves into from above and then turns away higher. Here as well. So we have a support to the downside and we have the resistance to the upside. When we find a pattern, so here we have, for example, a wedge pattern below a resistance area, there's a good chance that the market is not being able to break above it. And if we see signs that the market is not breaking above it, then we can look for reversal trades. So looking for a short from a resistance area makes a lot of sense if there are enough confluence factors. So here you can see the market is now showing more strength to the downside. The market failed to break the highs for multiple times. We're closing below the lows and we have our first entry point. If you are more of a conservative trader, you could also wait for the market to move away from a resistance much further. Here we have another swing area, previous resistance, support, the market breaks below that. So if you have missed the first example, or you're just more conservative and you don't like to trade too close to the resistance area, you could also choose this example. And then you can see the market move lower, very far away from the resistance. We have already talked a little bit about wave analysis, and I want to stress this again because it's a really important concept when it comes to understanding price action. So when we look at the chart, we can see different phases, right? We have a downtrend phase, an uptrend, downtrend, uptrend, downtrend, and so on and so forth. And that's how the market always moves in trending markets. The trends, they don't move in one straight line, and you will always see this back and forth between buying and selling phases. And the way those different phases shape, the steepness, the length, the height, those things tell us a lot about the underlying dynamics. Who is stronger, the buyers or the sellers? Who is in control? Who drives the price more? Who is driving the price for a longer period of time? Those are really important areas and concepts that we have to analyze. So let's break this down. What do we see here? The market is showing us an impulsive wave, very strong buying, weak selling, strong buying, weak selling. So overall, the market is in an uptrend. The buying phases are much longer, the selling phases are much shorter. So it makes more sense to look for continuations, right? We want to look for those transitions between the impulsive and the corrective phase. When is the corrective phase ending? When is the next impulsive wave starting? And that's where wave analysis comes in. Another important thing is that it's really important to understand how many impulsive phases go on. If we want to take a look at, for example, Elliott wave theory suggests that on average you have 3 impulsive phases during a trend before a trend rolls over. We're not going to get too much into Elliott wave. It's more in the program, in the Tradecademy that I have designed. We're going to take a deep dive into a lot of different wave theory examples. But just to give you an idea, those are the things that we can also do with wave analysis. And you can see the corrective wave rolls over here once again, starts the next impulsive phase. So we have 3 impulsive phases, right? 1, 2, and the third one. And at that point, the reversal to the downside is a little bit more likely. However, we still need more confluence. We need a long distribution, we need the right pattern. One of the patterns that we have explored in the past, head and shoulders, a wedge, a double top, a fake out. Those are the things that we now want to see after the third impulsive phase. Daily high-low is just so important. I talked about this in the very beginning when we just looked at the highs and lows. And we have to repeat this because it's one of the most important concepts. When we look at this uptrend, what do we see? I've drawn in here the lows, and you can see the market, except for one time, was never able to break a previous low. There were some rejections of previous lows, but there was never a close below a previous low, right? And this is how an uptrend unfolds. Yes, the market sometimes challenges a previous low, but for the most part, you will not see the market being able to close below a previous low. If this changes here, and here this is different because, again, the market has been trending higher, so for a long time, so the market is more overextended. We also see a much longer sideways period. The longer, as I explained in the beginning and in other parts of the video, the longer the corrective phase, the higher the likelihood that you're going to see a move against it. Then we have to push to the downside. We're taking out the previous lows. And then you can see that's where the trend really changes. So the daily high-low is just so important for our understanding of trends and we can really observe the strength of the trend. There's a very great indicator for TradingView that you can use. When you just search for daily high low, it's the one from Unknown Unicorn. Thanks again for providing great indicators here for free. It plots the daily high low on your charts. So the red line is the daily low, and we're on the 1 hour. So we get information from the daily candles. Where's the daily candle high? Where's the daily candle low? And what we see in this uptrend is that the market, except for here, rejected the daily low only once, never came close to the daily low until we have the long-term distribution. The market always took out previous daily highs. This changes here as well. The market is not able to push into daily highs again, but is now taking out daily lows, and that's where we roll over. So looking at lows and highs of candles, looking at the daily high and low is so important for your understanding of the trending dynamics, the trend strength and the direction. Trendlines and channels are also super popular. A lot of patterns use trend lines to describe the price action, and they're just great for our trading. So what we do is we look for those parallel channels. In an uptrend, we connect the lows, we connect the highs, and that's how we build a channel. And what you will often see is that once you have an established channel, the market often bounces between the upper and the lower boundary of the channel, extending the trend higher. And you can see that here for many times the market pushed into the daily channel high, moved lower, pushed into the low of the channel, moved higher. Then we have the breakout. What does it mean? Usually it means there's a final push to the market trend, especially after a long period. If you see after a long channel, a long trending move, the market is pushing higher, be very careful about this. It is typically not a sign that the market is suddenly going to accelerate and move even further and move stronger higher, but it's often a sign that a reversal is going to happen, or at least a sideways phase. We don't know if this is going to reverse, but there's a good chance we're not going to see a continuation. And now what we see is that the market is pushing into a previous low. We are already, or previous high, sorry. We're already taking out previous lows here. Now we need to wait for the market to get out of the channel and break into a low here. And that's a very important signal then that the market might be turning around. We see we are making lower highs already. Then we have the breakout here. You can see we closed very strongly. Below this area, we're taking out lows. And then the market is reversing to the downside. Now we have a new trend line to the downside that we can use. And when the market is pushing back into the trend line, we see a new impulsive wave being started. So during corrective waves, the market is pushing into the trend line. During the impulsive wave, the market is moving away from the trend line. Corrective wave into the trend line, impulsive wave break outside away from the trend line. Then the trend line is being broken, the market is shifting here and going sideways. So trend lines help us really nicely understand trending markets. Not always will you be able to draw a trend line, but if you can find a trend line or maybe even a channel, they can be really helpful in your price understanding and in your trend analysis. Now we're going to take a look at supply and demand strategies, how we use volume and liquidity. And those are some of the most important price concepts, because that's where we're going to start putting everything together. I will explain some of the best trading strategies that I've been using for over 10 years. We will learn how to do trading plans, how do we scan the market, how do we find the best trades, and many other important things that will help us put everything to the test, help us to apply it in a live market so that we can find the best trades, get ready for the trades, and then hopefully improve our trading and trade better. But this is going to come in part 2, so make sure that you stick around, and then in part 2 you will see how you can use that in your own live trading step by step.